Hello guys, I want us to look at this question. This is a net present value question. This is the question we'll solve. Danko for today's recording. Let's quickly read through and you'll see some of the concepts that we have been looking at for the past 3 videos. Danko has undertaken market research at a cost of 200,000 in order to forecast the future cash flows of an investment project with an expected life of 4 years. 4 years, and the cash flows are given just under, the sales revenue are given, the cost values are also given. And said these forecast cash flows are before taking account of general inflation of 4.7, so we've been given inflation rate. The capital cost of the investment project payable at the start of first year will be $2 million. So that is probably an equipment or something of capital in nature that has to be bought. The investment project will have zero scrap value, so there is no scrap value at the end of the 4th year. But the level of working capital, so you can see they've introduced working capital as well, at the start of each year is expected to be 10% of the sales revenue in that year. So which means the level of working capital investment at the start of each year, every year there's a working capital requirement, and we expect the working capital requirement from that beginning of the year to be 10% of the sales revenue for that particular year. So we have an understanding of what the working capital requirement will be. Then the capital allowances will be available on the capital cost of investment, that is a 2 million, and that will be 25% on a reducing balance basis. So take note, it's not a straight line method. Now this one is a reducing balance method. Danko pays tax on profit at an annual rate of 30%. So that's the tax rate, and tax being paid 1 year in arrears. Now you can see tax is paid in arrears. But Danko has a nominal or money terms after cost of capital of 12%. So they've given us a cost of capital, which is a nominal cost of capital. And nominal cost of capital is the same as money cost of capital, and that's 12%. So if you remember the rule is that if you have a money cost of capital, then you have to use money cash flow. And look at the cash flow that they have given us here. They said this cash flow is before inflation, before taking account of general inflation. So if it's before inflation, then it means that this cash flow that we have is actually a real cash flow. Then we must convert it to money cash flow for us to be able to use 12%, or the other way is to convert 12% to real rates. Then we can use the real cash flow. Either way, we will be doing the right thing. But what we must make sure we do is to use real cash flow for real rate and money cash flow for money. But let's look at the requirement. The first requirement says calculate the net present value of the investment project in nominal terms. So this specifically says in nominal terms, which means we must use everything in nominal terms. Money cash flow, money rate. The second one says calculate the net present value in real terms. Then we must use real cash flow and real rate, and we'll comment on its financial acceptability. Then the last one, we'll just look at how directors can be encouraged to achieve the objective of maximization of shareholders' wealth. And that's theory. So these are the 3 questions we have to solve with this case. And let's go into it straight away. Very interesting question, and I like it. Let's see. I'll look for. I think I have a question here. Yeah, it's Danko. So let's look at Danko. If you see some of those concepts I always mention in my previous videos, you can see them here. The concept of sunk cost is being tested here, which is not relevant cash flow. I told you must be able to identify irrelevant cash flows that you don't need. Not relevant means it's irrelevant, right? That concept is being tested here, and that is the 200,000 you see here. Yeah, that 200,000 US dollars, it's not a relevant cash flow. Why is it not a relevant cash flow? The question says that Danco has undertaken a market research. So the research has already been done and the money has already been incurred. So it's a sunk cost. So the research could have come and say this investment is not good investment, or this data is not good, we can't get any data, and in that case you won't be able to do investment. So that's why it's a sunk cost. So it's not a cost that will be incurred as a result of taking an investment decision of going into this particular opportunity. We have already incurred it and it's not relevant. It is not a cost we are incurring as a result of doing this investment. So because of that 200k is irrelevant and we will not be using it. So that concept is being tested. I can see the concept of inflation as well is being tested in this question. And as you can see, the cash flow that we've been given, they said, has been given before taking into account a general inflation of 4.7%, which means the cash flow is a real cash flow. That concept is being tested. Another concept I see here is working capital, which we have looked at. Working capital, you can see the question says that the level of working capital that is required at the beginning of each year is expected to be 10% of revenue of that year. So that concept is being tested here, and we need to know what that will mean in terms of cash flows, which is what we'll be using to plot our cash flows for PV calculation. Likewise, taxation. You can see taxation concept is also in this question. That's why I love this question a lot. To put a lot of things together. See, capital allowance on the capital cost. So first of all, remember I said taxation is in two views. You pay and you receive credits. So we'll do this one on profit when we plot our cash flow, and we'll receive tax credit when we calculate the capital allowance. Capital allowance. We'll deal with that there because we have to calculate capital allowance. And when we do that, they said the tax is paid even in arrears, which is, if you remember, I told you that's another way they can confuse you. The way the tax is being paid. It's paid in arrears, and the way you plot tax that is paid in arrears is different from the way you plot the cash flow that is paid in the same year when the tax is due. So all of this we need to put into consideration. So all these concepts is what we're going to be working with in this question. The first question asks us to calculate net present value of this project in nominal terms. So that's the first one we want to do. NPV in nominal terms. And I told you nominal terms is the same thing as money cash flow. Nominal terms means with inflation. It means with inflation. That's the meaning of nominal terms. With inflation. Please take into take it very seriously. It's the way they can try to confuse you. Examiner likes to use different words. Money or nominal, they are the same thing. Now let's look into our cash flows now. So we need to start plotting cash flows. So this is for net present value calculation. We use our normal. So we have year. So let's say we have year 0. So for NPV calculation, please take note of this template. For investment appraiser, we're going to have year 0. The tenure of this investment, they said, is 4. So we have year 1, year 0, year 1, year 2, year 3, year 4. And please take note, because tax is paid in arrears, that means the tax for year 4 will be paid in year 5. So that will be year 5 in this workings that we'll be doing, right? So I want to start with, let me delete this so that we can have enough space. Make it a bit smaller, so I'm going to have, so just know that is year on top of that. So, but let's start with the P&L item. Please take note. Always start with P&L items. When you finish with P&L items, you get your tax payment. Then you go into the balance sheet or statement of financial position items, so that your cash flow, you don't mix the statement of financial position items with P&L items, and you get the tax payment error. Please take note of that. Right, so let's start with revenue, which I'll call working one. Yeah, so revenue is working one for us, and I will put it, let's start our workings from here. Let's give some space. So let's say revenue working one. I'll plot it later. Let's do they give us cost. So cost, I can call that working two. Then we have the profit before tax, which will be revenue minus cost. We'll get that. Then we get the profit before tax. Then we can get our tax, which will be at, they give us at 30%. Then we're going to get profit after tax. Yeah. Then after profit after tax, we are done with P&L item. Then we can add the cash flows from the balance sheet item, which start from the initial outlay, which is the initial investment. After initial investment, we're going to have the working capital. Then we're going to have the tax benefits on the equipment. So we have the tax credit. Yeah, it's a cash flow that's given to you on the cash flow on the statement of financial position. Don't add it to P&L. So once we do all of that, we can have a total cash flows. Yeah, so we have the total cash flow here. When we get the total cash flow, then we get the discount factor. The discount factor. The first one we are doing is a nominal calculation, and we are lucky. The rate that has been given to us as well is a nominal rate. So we'll do at 12%, which is fine. We don't need to do any calculation there. We're going to get a discount factor at 12%. Then we'll get our PV, which is the present value. Yeah, present value is the cash flow multiplied by the discount factor. So we get the PV. And once we get the PV, we'll add all the PVs together and we'll get the NPV for that question, for this question. Yeah. So that's the way we're going to approach it for this question. Now, keep it as simple as much as possible. 4, 1 to 2. Okay, so I need 3 here. Second year here. This, yeah, fantastic. So do this. Want to avoid confusion as much as possible. Working capital. Yeah. That's credit. Yeah, that's down. Has to actually go down. Awesome. Now, so let's start with working one, which is on revenue. Because the revenue has been given to us at real rate. Rate cash flow 1,250. They said before the inflation. So for year one, our revenue will be year 1, year 2, year 3, and year 4. For year 1, revenue will be 1,250 multiplied by, remember the formula we are using is future value equals to present value into 1 plus r raised to power n. So for year 1, our future value will be, the current value is 1,250 into bracket 1 plus 4.7% raised to power 1. And that will be equals to, is the calculator, 1.047 times 1250. And that gives 1309. So year 1 is 1309. So we have that here for year 2. So this is year 1. For year 2, the same formula. All the cash flows are given in current terms. So it remains 257. So present value remains 2570 into bracket 1 plus 4.7%. This time around raised to power 2. Please, it's still raised to power 2, because I see students sometimes they make mistake, they say raised to power 1 because this is year 2 figure. No, the year 2 figure is given in current terms, which means it is given as if it is now, not year 1. So it's not a year 1 figure, it's a year 0 value in year 2. So you still need to raise to power 2, so which means it needs to take inflation twice, from current value to 1 year, from 1 year to 2 years. So it's 2 years raised to power 2. The most common problems, mistakes I've seen with students is just doing the inflation once. No, please don't make that mistake. Like I said, don't make that mistake. Students make these mistakes a lot. So 1.047 raised to power 2, then multiply by 2570, and that gives 2817. So we'll do the same thing for all the years. Year 3, the same thing. That's 6890. 1 plus 4.7% raised to power 3, and that gives 7908. And likewise, if you do for year 4, you'll have 5444. So let's plot our revenue. Nothing in year 0, but in year 1 we have 1309, 2817, 7908, then 5444. So that's our revenue. We use the same approach for cost. Working 2, which is for cost. Yeah, current value was given at 500, so that will be year 1 will be 500 times 1 plus 4.7% raised to power 1. So 1.047 times 500, that gives you 524. So approximately 524. And we'll do just the same way we did for revenue. We'll do for year 2, year 3, and year 4. And if you do that, follow the same approach, you have cost. But please remember, cost is a cash outflow, so you need to put it in brackets as negative. So 524. Year 2 will be 1096, 2869, and you have year 4 to be 2103. That's simple as that. Then the profit before tax is revenue minus cost. So 1309 minus 524, and that gives 785. The next gives 1721. Next is 5039. And the next one is 3341. So we have our profit before tax. Now, tax is paid at 30%, however, in arrears. So which means the tax for year 0 will be paid in year 1, so there's no tax in year 1. But year 1 tax of 785, which at 30% is 236, will now be paid here in year 2 because it's paid 1 year in arrears. So which means there's a 1 year delay. 236 here. 30% of 1721, that's 516. We pay in the following year. And 30% of 5039, that's 1512, paid next year. And you can see why we have year 5, because the 3341 times 30% in year 4 will be paid in year 5 because of the fact that tax is paid in arrears. So that is a tax payment, 1002. So that's the tax payment at 30%. Right. Now, what is profit after tax? That is Profit before tax minus tax. So we have 785 here as net. Here we have 1721 minus 236. That's 1485. 1485. Then 5039 minus 516. That's 4523. 4523. Then 3341 minus 1512. That's 1829. 1829. Then this comes down to be 1002. So that's profit after tax. So we are done with P&L items. Now let's move to the balance sheet items. Initial outlay, which is what we consume, what we invested in the beginning, and that is this 2 million. Yeah, that was given to us. Yeah, so initial outlay is into bracket 2 million. 1, 2, 3, 1, 2, 3. Yeah, 2 million. Now working capital, I'll call it working 3 because I explained this in my previous video, but let's see it now in action. Working 3. So the working capital requirement for each year. So remember the question says, let's look at it. Very careful, please. So the level of working capital, look at this, at the start of each year is expected to be 10% of the sales revenue in that year. So this working capital is required at the start of the year. So which means that for year 1, let's say year 1, year 2, year 3, year 4, the opening working capital is a function of the revenue. So year 1 revenue is 1309, as you can see, 1309. So which means 10% of this is the working capital requirement for at the beginning of year 1. 10% of 2817 is the working capital required at the beginning of year 2, right? And likewise in year 3, 791 will be working capital required at the beginning of year 3. Now, let's go into the plotting now. So in year 1, the opening working capital that we need will be 131. In year 2, it will be 282. That's 10%, 791, just as I just showed you on 544. Remember, I calculated this 10% after I've calculated the nominal value because this question wants net present value in nominal terms. So everything must be done in nominal terms. Yeah. So this is opening. But doesn't mean that is a cash flow. That is not the cash flow. If you're going to have year 131 working capital in January year 1, you need to buy it December the previous year. That's what it means. Because remember, when you want to discount cash flow, all the cash flow you are discounting are assumed to must have happened in the end of the year, December. That's why you are discounting to January to get the present value. So when would this opening, if you need it 1st of January, then you must have bought it in December. So which means the cash flow will actually happen in year 0. So in terms of cash flow, if I want to do the cash flow, so the cash flow effect now is that this opening of 131, I must have bought it in year 0. Yeah. Then this opening of 282, I must have it by the end of year 1. And for me to have it end of year 1, I open with 131. How much do I need to buy more during the year? It means I need to buy more 282 minus 131, which is the concept I was explaining to you in some of the video. I think it was the last video on working capital, or 2 videos away. Right, so it means I need to buy more 151 here to get 282 in year 2. And to have 791 beginning of year 3, I need to buy 791 minus 282, sorry. So that is 509. So I need to buy 509. So because for NPV, you're only interested in cash flows. Yeah, and for year 4, I only 544, but I ended year 3 with 791. So here I'm going to be selling to bring it down to 541. So 791 minus 544. and that is 247. Please, if you are getting confused with this, watch that video 2 videos away. I think that last one or the 2 videos ago, I explained this working capital effect. Yeah, because I know we're going to start seeing it in calculations, and I took time to break it down for you there, but please follow through. So 247, I'm going to be selling. When I sell 247, then I can open my year 4 with 544. I also sounded warning like 5 times in that previous video that remember, and I'm going to be sounding that warning again, recover your working capital at the end of the investment. So this 544 will be recovered, which means it will be sold at the end of year 4. So this line is my cash flow that I need for working capital, and so this is what I'm going to take up there as my working capital cash flow. So I go here to plot my working capital cash flow. I have 131 negative, I have 151 negative, I have 509, I have plus 246, and I'm recovering the balance of my working capital at the end of the investment, 544. Right. So that is working capital. Then the tax credit, let's say working 4 for that. Working 4, that's another important one. So let's do working 4 for tax. Remember, tax is about depreciation. Yeah, and this is said is 25% reducing balance. That was given. So we're going to have cost. We're going to have the capital allowance. Yeah, and we're going to have the tax credit. I can call this depreciation so that it's pretty easy for you. So depreciation, the net book value, then I can give the tax credits in a column, which is what we really need. So year 1, year 2, year 3, and year 4. Please pay attention. This can also be very tricky. So we're going to have cost at 2 million. So we'll start with 2 million. Depreciation at 25%. Net book value at the end of year 1. So 2 million multiplied by 25%. So that's 500,000. So that's 500,000. And that's left with 1.5 million. 1.5 million. So let's do it in thousands so that it's faster. So I'm going to open year 2 with 1.5 million. Then the depreciation. So let me just change everything to thousands. So I don't have to write everything full. So I'm going to just do it in thousands. Yeah. So this is 1,500. So open with 1,500. 500 times 0.25. That's 375. So the position is 375 here. And that will close at 1125. And open with 1125. At 25%, you have 281. And that gives me 844. So I'm open with 844. Okay. Multiply by 25%. That is depreciation of 210 or 211. So I go 844 minus 210. Please pay attention to this. So 634. And you can see that for year 4, we still have a net book value that is hanging there. And that is what you always get, especially when you have reducing balance method. But we'll come to that. Let's get the tax credit. The tax credit is always a percentage of tax multiplied by the depreciation, and that's your capital allowance. So for year 1, that's 500 times 0.3 because the tax is at 30%, right? The tax is at 30%, right? So that's 150. So tax credit for year 1 is 150. For year 2, 375 times 30%, 113. Then 84. If you multiply this by 25%. But for year 4, there will always be 2 types of benefit which you need to add together. The first one is 210 multiplied by tax, which is 63. Also, because there is a value left here, it means that you need to calculate what we call the capital allowance or capital charge. Yeah. Sorry, balancing allowance or balancing charge. Balancing allowance or balancing charge. So balancing allowance is when you make loss, but balancing charge is when you make profit. So you pay balancing charge, balancing allowance is a credit. So this is a credit, and this is a payment. So which means this is negative, and this is positive. So for this transaction, let's see whether you make loss or you make profit. What is the scrap value for this asset? Decide the scrap value. Let's look for it. It was set somewhere. It said investment project. This investment project will have 0 scrap value. So which means the selling price for that equipment is 0. But the book value is equals to 634. So is that a profit or loss? That is a loss of 634. And in that case, when you make profit, you pay tax. But when you make loss, you get credit. So that's why this is a balancing allowance at 30% times 634. And that will give you 0.3 times 634. That's 190.2. So you have additional credit of 190.2, and that's the second part. So please always remember, for the last year, your tax is always in 2 parts: the usual capital allowance and balancing allowance and balancing charge. So if we add these 2 together, these 2 will give you 253. So that is a tax benefit for year 4, and that's what we're going to plot in our cash flows here. So for tax credit, we're going to have 150, but remember it is in arrears. Please take note, because tax is paying arrears, the benefit will also be in arrears. So you're going to get 150 here in year 2. Year 1 tax benefit will be collected in year 2. Then the 113 will come here, the 84, and the final 253 at the end of year 5. Yeah, so we have all the cash flows, and now we can now get the total cash flows. Remember, we are working in thousands, so I'm going to change this to 2,000 because we are working in thousands, just to have the alignment. Yeah. So for the first year, the total cash flow will be minus 2131. As you can see, this one is 634. So I'm just adding this. So I'm adding, so now you see what I'm adding. I'm adding 1, line 2, line 3, line 4. Those are the 4 lines I'm adding together to get this part. Right, so 1485 minus 509 plus 150, and that's 1126. 1126, and this is 4882 2457, and the last one is minus 749. And discount factor at 12%. Let's go to our discount factor table, which is a present value table. At 12%, This is 12%. Yeah, here 12%. Year 1, 0.893. So for year 0, discount factor will always be 1. Please take note. 0.893 for year 1. 0.885 for year 2. No, sorry, 0.797. I made a mistake. I picked the wrong one. I should be picking this one. So this is year 2. 0.797. 0.797. 0.712. Then 0.636. 636. And the last one is 0.567. So if I multiply this and this, that gives me the present value. So that is 2131 for the last one. 2131, still negative. This one is 567 positive. 898. If I multiply 4882 times 0.712, I have 3476. I have 1563. Then this is negative 425. And those are the present value for each year. So if you had negative 2131 with 567, 898, 3476, 1563, and negative 425, you have a total NPV of positive 3948. Yeah, and the question asks us to comment whether this is financially acceptable. So this is yes, it is financially acceptable. The company should go ahead and do this project. Why? Because of one reason. NPV is positive. And that is the only reason why you will advise a company to do an investment using NPV technique. Remember, I told you we'll be spending a lot of time on NPV technique, and that is just part A of this question done. The next video I will address part B, and we'll finish this question with part B and C in the next video. Yeah, remember, continue to like, ask questions, and comment. Thank you.